We are live. Hi, everyone. I'm Matt Cropp with the Vermont Employee Ownership Center, and I'll be running some of the tech on this call today, as well as presenting a bit. And I just wanted to let folks know that we are recording the call. If you'd like to submit questions, you can do so through the Q&A or chat function, kind of in the midst of the presentation, and we'll be stopping at different kind of section breaks to answer those questions. During the final Q&A, attendees also will have the option to sort of either submit questions by text or join the video call and ask and discuss. There should be a raise hand function that you can use. And if you'd like to sort of join the conversation, you can just raise your hand virtually, and then I can push a button and you'll be added to the group. So with that, I will pass it off to Luann for an introduction and some additional housekeeping.
Thanks, Matt. Hi, folks. I'm Luann Beninati. I'm the Director of Program Viability Strategies at Let's Grow Kids, and we are very pleased to partner with the folks on this call today who will be introducing themselves to present this workshop. Just some quick housekeeping items. Many of you participating do want hourly credit through Northern Lights for participating in this. You are welcome to stay on this training as long as you want to, but anyone who is interested in getting credit for it through Northern Lights will need to stay on for the full amount of time. So just want to let you know that. And then if you have a BFIS number and you did not put it in the form as you signed up, please either put that in the chat box or email that to me, luann@letsgrowkids.org. So I think that's it for me. I'm looking forward to this, so I'll pass it on to Lynne.
Thanks, Luann. I'm Lynne Silva, and I'm the principal at the Silva Group in Burlington. And we handle business brokerage and low-end mergers and acquisitions. At this point, I've been doing this work for 16 years. I've handled a very wide range of exit planning projects, as well as actual business sales where we're bringing someone on the market. I've handled transactions as small as, very little business selling to a single key employee, to sales to all employees, such as ESOPs or worker cooperatives. More recently, I've moved on to larger, more complex, multi-million-dollar sales of pretty large companies that are going to private equity or strategic buyers. And at this point, I've seen the inner workings of hundreds of businesses, including childcare centers and private schools. So I'm hoping what we can all share today will help you all better plan for an exit that will occur in the future. And now, Heather, why don't we have an introduction here, if you wouldn't mind?
Thank you, Lynn. Hi, everybody. I am Heather Hurlbert. I am a loan officer with Vermont Community Loan Fund. And we are a mission-based lender based out of Montpelier. We typically lend to marginalized communities, women-owned businesses, and of course, childcare centers. And over the years, we've become quite experienced at being able to see all the nuances and the details and the uniqueness of lending to childcare centers. So today, I hope to provide some basic information regarding lending during a sale of a center, a little bit of information regarding what a loan officer looks at for underwriting purposes, and just to provide some guidance as to things to think about when you are in the market to sell a business, talking with a buyer, some of the information that you're going to need to put together to be able to do that.
Great. I think, Matt, are we ready to move to the slide deck?
Yep, I will start the screen share now. All right, here we go.
Okay. I guess I'll jump in here. We've introduced ourselves, and really two objectives today. Help you understand what the pathways are and help you start planning now, because starting to plan now is the best way to have a good exit. Next slide, please. Okay. And then let's move to our agenda. We have 3 major sections today. The first is just a brief overview of transitions. And transition means a change in ownership, whether you're selling it, and I think we have a nonprofit on today. In your case, it's just a transition to different management, a different executive director, but that takes planning as well. Most of what we're talking about today, except for the business valuation section, will apply to nonprofits as well. So we'll talk about the planning, what elements you should think about when you're planning for a transition. We'll lay out the transition pathways. There are 4 main pathways. And then finally, we'll have time for additional questions at the end. But like Matt said, feel free to ask questions as we go through each segment here. Okay. So first we'll do an overview of the transition. All businesses are sold or transferred, and unless you just close it down or liquidate it by selling off the assets. The challenge is that privately held companies can't be, like if you had a public company, you have shares, you just sell them on a stock market when you're ready to exit. With a privately held company, there's no ready market for your ownership. You have to create your own exit pathway. And just emphasizing some advanced planning can really help you have a successful transition. Okay, we have some very specific challenges in this childcare industry. Frankly, many smaller childcares will not be saleable under the current mode of operation. This is something we've added to this presentation. We're going to talk about this more later, things you can start doing now to help make your businesses saleable. And just emphasizing, you may need to adapt your operating model in order for an ownership transition to be viable. Perhaps as an incentive to that, anything you do to make your business more saleable will often make you more money and make your life easier until you get to the point of a sale. So really, it's just a win all around. Okay, and just one more add as we're switching slides here. Obviously, we're in a time right now with COVID of great uncertainty, and there's been a relatively good amount of attention paid at the state level to childcares. This is an opportunity right now to band together and to really work for some changes that can make this industry more sustainable and your lives easier and more secure. So let's move into planning. First, why plan? Well, talking about it may change how you're operating until you're ready to actually move on. It's also going to save you time and money when you are ready to start the process of moving on. So when you sell a business, whether it's a simple sale or more complex, it takes time, and that time is on top of your normal day job running your center. So anything you can do to become organized before is really going to make your life easier when the time comes. And then tax liabilities, taxes are owed on the net proceeds from the sale. And you can do some things to position before a sale that are going to reduce how much you owe. You can do some smart strategies there. Okay. Let's move on. Okay. So general considerations, basically when you transition, can you ensure your employees and your customers, the families you serve are well cared for? Have you set up a transition that allows the center to continue in a healthy way? Can you protect your business legacy and place in the community? I mean, clearly childcare is an essential business. It's really important to keep these centers running. And then another thought, what does your business require to succeed in the next generation of ownership? businesses evolve over the years and the landscape they operate in evolves. If your business has grown a lot and the circumstances have changed, it's good to think about what skill set is needed next to lead. So as we're looking at planning for an exit, one element to think about is timing. And how early should you start thinking about your transition and planning for it? I do a good bit of exit advising and exit planning, and if we have 2 years before the desired exit, that's a good time if you're able to start thinking then. I've had clients start 10 years in advance. I've also, you there, Matt? Okay. I've also had people need to go on the market immediately due to a health issue. But if you have 2 years, that's a good time to start thinking about this. It's going to take some time to research the options, to adopt some changes, to organize your records, and perhaps work with your personal financial advisor. The other thing, as I mentioned earlier, you're doing all this exit work on top of your regular day job, so it does help to pace it out. One consideration when you're thinking about an exit is your emotional readiness to move on. Leaving a business that we've started, perhaps grown, been with for years, that's one of life's largest decisions. It's a really major life transition. A lot of the folks I work with, it takes them, I see, several years to become really clear that they're ready.
And Lynn, if I could just jump in, I think that's a particularly an issue that comes up in the field of early care and learning because it's such an emotional business and people often lead with their heart. So I think you make a good point, and it really relates to the sector that we're talking to today.
Yeah. And another consideration to be aware of is that when an owner sells a business, the buyer, or at least the buyer's attorney, if they have a good one, will insist that the seller sign what's called a non-compete agreement. That agreement will typically mean you can't open and run a similar business within a competing geography for a certain number of years. That's important to know because there's not necessarily a backup game plan. If you get out and need more income, you can't start a competing center. You may be able to work for another center, but you can't run one in the same geography. And then when's the right time? We talked about ownership as the owner is just really looking at what makes sense for you emotionally, financially. And then is the business itself ready and saleable, which is what we'll be talking about in the next couple slides here. If we could switch, Matt, there we go. So is the business saleable? Before we even start with the value of the business, we look at, could it be sold? Not all businesses can be sold. You know, if you had something, say, video stores, remember them? That industry simply is not viable. But when we look at considerations with saleability first, could it survive without you as owner? Are your staff ready to backfill your key responsibilities, which tend to be marketing, customer or family relationships, in this industry, regulatory compliance, and then, of course, financial management? Are your customer agreements transferable? If you have written agreements with the families, you could have your attorney take a look at them, and this is something I recommend you do a couple years before you're ready to move on. Sometimes the agreements can be written in a way where they would transfer to a new owner of the same center. That's what you want, because that way the new owner is assured that those families will stay on. So that's something to have your attorney look at. The other issue where your attorney might be helpful is your lease transferable to a new owner and of sufficient length. I mean, any new owner or the landlord will have to approve them, but you should have options on the lease to extend the lease period if desired. You know, daycare facilities, they're very location specific. You can't create the same business by moving it 2 or 3 miles away to a new facility. You may lose some of your families. So we'll come back to this, but when someone buys a business, such as a daycare, they take out a business loan to buy it. And the bank is going to insist that the lease is at least as long as the length of that business loan. They want to be sure you can stay in that location until the loan is paid off. So looking at your customer agreements in your lease, maybe put those on to-do list for the next time you're updating your agreements with your attorney, because you can help yourself out a lot with that. Okay, next slide. Prep work. Are your financial records in good order? So you may need to provide anywhere from 3 to 5 years of financial records. When I do business valuation work, I like to see 5 years. You start to be able to see some trending with 3 years, but with 5 years, you can see trending. Banks may not need as much, but your financial records will be used by the business valuator. They'll be reviewed by the buyer, and the lender will also see them. So having this information organized is great. Generally, they'll need your federal tax returns. They'll need P&L statements, and they'll need balance sheets, and everything should be kept current. So, monthly P&Ls and balance sheets, if you can generate them, like if you're running QuickBooks, that's an option. Those can be incredibly helpful to your buyer. What we're talking about here are ways to facilitate the sale of your business. And as an owner, you can do a lot to make this easier for a buyer. If you have monthly financials, the buyer can use them because they have to build a business plan from scratch, which is based on monthly projections. And that business plan is reviewed by the lender, who may consider giving them a loan to buy the business. These are very practical things that you can start organizing right now. Now, cash flow. So when someone buys a business, occasionally you'll see an all cash sale, no lending involved, but generally there's a loan, whether the seller is holding the loan or the bank or both holding a bit of it. So the buyer puts down a down payment, some cash, non-borrowed funds, and then they're borrowing the rest. What do they use to pay off that loan? They use the excess cash flow of the childcare center. So the business essentially needs to be profitable. A quick test for that. First, for the work you put in, are you paying yourself a market salary, what you'd have to pay someone else? And then after that, is there any profit left? And when I talk about what you pay yourself, if you're sole proprietors, whatever you take as draw, if you're, an S Corp, whatever you might take as salary plus the leftover profit. But is there any money left beyond paying yourself a market salary? If there is not, it's not impossible to sell the business. It's just not going to be able to support a loan, which means the price will probably be fairly modest, and you can only work with cash-only buyers. You won't be able to finance. You may be able to find some people who could do it, but if the center is more profitable, you have a much broader pool of buyers who would be able to get loans to buy the center. I've looked at many industries, the inner workings of all these businesses, including some childcare. And as Lynne mentioned, childcare it's a culture of caregiving first. And it'd be good to start also focusing on the business side at the same time. And women-owned business, women tend, let's face it, culturally, we tend to undervalue our time. Plus, we have very little governmental support for childcare in the U.S. Altogether, from the industries I've looked at, childcare has probably one of the tightest margins out there. It's a really tough industry, and many centers are operating on the financial edge, and it's really time for that to change. So we're going to move into a few more slides where Luann is going to talk about things that can be done to transition a child care center into a more sustainable and financially stronger operation. Okay,
So,
Luann.
Thanks, Lynn. So at Let's Grow Kids, we are very concerned about the business operations of the childcare field. And my role is working to support sustainability of childcare businesses. And Lynn's absolutely right. We spend a lot of time focusing on the quality of the early care and learning that we offer. We spend a lot of time focusing on the needs of the children and the families. And to make this system sustainable, we need to spend more time focusing on the business operations. And there's an organization called Opportunities Exchange, which is an amazing resource. I recommend anyone who has any interest in digging in a little bit more to go to their website. Their founder, Louise Stoney, is one of the most famous national early childhood financing experts. And so Opportunities Exchange has developed an iron triangle, which is what they've identified as the three pieces that really make a child care program a sustainable and strong business. And the three tenets are, first, having full enrollment. Are your classrooms full every day, or are you holding slots empty? Are you not so busy that you're not having time to fill slots? Or are you making a plan to make sure that based on whatever your desired enrollment is, that those classrooms are full? And we all know, as Lynn mentioned at the beginning of this, times are different right now, and we're reopening slowly, and classrooms can't be filled in the same way that they were before. But taking a real strategic look at your enrollment processes is a very important piece of being a strong business. The second one is collecting tuition and fees in full and on time. And this is one of the issues that has been identified as one of the biggest problems with childcare businesses being a sustainable and strong business. I've talked to directors who have 80% of their families paying late. That's not sustainable. And none of us have walked in the grocery store and walked out without paying for our groceries. And we have to really think in terms of the early care and learning that we offer is important, and without a viable business, you're not able to continue doing that. So you need to have a plan and a partnership with your families to collect your fees. And your fees need to be set on the per child cost. And we all know this is a conversation we've had across the state of Vermont with providers, with leaders, directors, and owners. And we know that the actual cost of care is not affordable for most Vermont families. But it needs to be recognized as the cost of care. And if in fact you are charging less than the cost of care, then that needs to be recognized as a scholarship that you are offering. And so knowing that these three pieces are difficult to maintain, and during this during COVID and post-COVID time will be even trickier to maintain, but paying attention to them and trying your best to reach these three tenets will make your business a little bit more sustainable and stronger in terms of passing it on to someone else. So thinking in terms of your business model, one of the things that we've talked about in terms of childcare businesses in Vermont is we tend to have small childcare businesses, smaller than the national average, and each childcare business has its own full administrative system, meaning that whether you have 10 families, 20 families, or 100 families, you have a director, you have someone to manage finances, someone to do maintenance, someone to do technology supports, and whatever the back office and pieces of to run your program, each one of your programs has this in its entirety. And that's not affordable or sustainable for childcare businesses. And so are there ways to adapt your business model to make it a more saleable, a stronger business, which then in turn is more saleable? Next slide. So one of the ways that you can really impact your viability is by looking into sharing services, joining together with other programs, and not giving up your individual business model, keeping your own individual identity, the culture of your program, the philosophy of your program, but gathering with like-minded early childhood programs to share some services. What that does is offers economies of scale. If you're going to Costco or Hannaford to buy food for your one program, you're going to pay more than if you gather together with a group of programs and order from a vendor that can give you a better cost, for example. Back office and administrative costs can be shared so that if you have a bookkeeper who knows how to do early childhood back office, instead of each program having their own individual finance person sharing that. And what you get, not only do you have an economy of scale by sharing that person, but instead of the director or the owner doing her best to manage her own finances, as we often do, you're getting someone who's skilled in that role. And so you get an economy of scale, but you also get an economy of expertise by having actual trained people do the work. And then the final one, there's many, but right for discussion today, the final one is there really should not be anyone who is not using electronic record keeping, billing, and administration. There are plenty of software systems built specifically for the childcare field, and they simplify and organize the bookkeeping, the collections, the payroll, and all the systems that take a lot of time when being done individually. And it's hard to even say, but still in many cases on paper in childcare businesses across the state. So looking into changing your business practices by gathering together with like-minded owners, directors, to share some services to gather economies of scale and economies of expertise can help sustain and strengthen your program.
Okay, we're going to move into an overview of business valuation right now, just to give you a sense of how this works. This is not enough information for anyone to value their business, but just give you some things to think about here. The first question when you're planning is, will the likely proceeds from the sale meet your needs? Are you looking to retire? Are you looking to move on and do something else? Is that likely value sufficient? Many people find it very helpful when we're doing exit planning. We usually do at least a rough business valuation. My clients typically take that information to their personal financial planner and ask that person to put it in the mix and help them sort out, will that suffice to retire and at what time? The exit planning and the business valuation can have a big impact on your decision of how to time your exit. If the value comes in lower than is needed for you to retire immediately, for example, a lot of people just stay in a few more years, keep taking the income, grow up the business a bit, and then sell at that point. Next slide. So when we do a business valuation, which is work I do as well, so I'm pretty familiar with this, first thing, as we talked about, feedback as to whether the business is saleable. Is the industry viable? You may have individual concerns coming in, such a major chain competing to you, and just set up shop next door, just things to look at there. And you'll get a sense of the likely value range of the business. And I use value as a range. There's no single answer. Valuators, whether it's a broker like myself or a CPA, your accountant can run these. All of us using, standard practices will come up with slightly different numbers. There's subjectivity here too. But for planning, getting a range in mind, I think is helpful. The reality of the value is what an actual buyer ends up paying for it. That the value is from ultimately the acquirer's perspective. So when we talk about value, particularly if it's financing, again, the cash flow has to be high enough to support the value. And just when we look at the bigger picture here, if you're working with a lender, your buyer is working with a lender, that lender can be very helpful. Sometimes they'll have their own opinions of value. They're essentially the third party in the transaction along with the seller and the buyer, and have a lot of good perspective given how many inner workings they've seen as well. Okay. So with evaluation, we also look at value drivers as well as detractors. Some things in a business bring value, which we'll talk about, and some don't. And if you're going to operate for value, you should focus on the things that are increasing value. And then looking at the viable exit pathways for your business. Of the main exit pathways, not all will apply to each business. Okay, next slide. Okay, most business owners overestimate the selling value of their companies. That is human nature. Everybody starts with blood, sweat, and tears. That's, it's pretty global. And we also see online all these references to multiples. We're seeing public companies selling for a 12 multiple in EBITDA or something like that. When we talk about a multiple, we talk about the number that's used to multiply against the earnings of the company to get your selling price. So a valuation multiple for a company that has $1 billion in bottom line earnings doesn't apply to a company with 500,000 in bottom line earnings or with 10,000 in earnings. The higher the earnings of a company, the higher the multiple gets. And I'm going to show you some examples in a slide because I want to encourage you to think about perhaps scaling up, combining forces. A lot of businesses operate at what I call the awkward in-between stage. It's just enough to get by at, but if you were a little bit larger, you get some efficiencies of scale and actually start making money and be able to staff to a decent level and have some backfill for yourself. Okay, next slide. Okay. Whoops. Should be on slide 20. Yeah. Here we go. So in general, value drivers for any business are well-trained staff, an established and transferable customer base. We talked already about making those customer contracts transferable. A history of revenue growth. I'll stop a minute to talk about COVID because, this is an odd year. I've lived through the Great Recession, saw what happened to businesses. Once the economy opens up again, if you get your centers back up and running, everybody's going to understand that we had a gap for a while, whether it's a full year or what. It's going to be an odd year. So you get a pass a bit on that one. The question will be, can the center come back after COVID? Consistent profitability without major swings from one year to the next, except for COVID times. Established business processes, including good financial records. And like Luann was talking about, most businesses and most industries are moving to electronic record keeping and electronic management. The more of that you can do, the better. And then what's the business image? Is your center well known and really positively recognized in the community? That can go a long way. The next slide, Luann is going to talk about. These are value drivers very specific to the childcare industry.
So some of the value drivers that we deal with in our businesses are the proportion of infant, toddler, and preschool slots. As we all know, generally infant and toddler slots are more expensive to offer than preschool slots. although because preschool slots to partner, that preschool slots that will enable a program to partner with the Agency of Education around Act 166 will require a licensed teacher, which will require some expense because you'll have to pay a licensed teacher more. One of the things, as Lynn's talking with some of the other slides, and I'm in my mind paying attention, one of the things that is a part of this business model that we're dealing with is the low salaries that we pay and how that affects our bottom lines and our businesses and our saleability. So it's just something, Lynn, that occurs to me as you're talking. That's another piece of this that we haven't really thought about. But generally, infant slots are the most expensive to offer, and so a balance of ages and slots will make your program more stable. Having partnerships like Act 166 to bring in education funding to augment parent tuition and Agency of Human Service Child Development Division funding for childcare financial assistance. Childcare financial assistance funding, again, just the basic childcare financial assistance funding will pay less by and large for most of you across the state, with the exception of, I believe, one region of the state. CCFAP payments are less than what the going rate for tuition is in most parts of the state. But the higher your star rating, the higher your reimbursement. And so those are all pieces of things to consider, making sure you have a 5-star rating so that you're getting the highest reimbursement rate will go a long way toward stabilizing your program in terms of sale. And then basing your bottom line and your programming and your business model on a large amount of the budget on grants and fundraising is going to have a negative impact on value, because when in fact those fundraising activities or those grants end, then where does the money come from? So grants and fundraising really should be looked at as a way to raise specific funds for a specific project, and not, in my opinion, be looked at as an ongoing part of your budgeting for the program.
I've got a couple slides now where I'd like to go through some valuation and transaction structuring examples. What I've done is I've done 3 scenarios with number of children in the program, say 10. These are full-time slots, and I'm not differentiating between infants and preschoolers. It's just, this is very rough to give you a sense of how this flows. So one center is quite small, 10, another good size at 75, and another up at 150. I figured estimated revenue per child, that's per year, about 10,000, could be more or less. I'm using industry metrics that I pulled from what's called the Business Reference Guide. It's one rule of thumb guidebook that you can use for rough valuations. And if you would like these metrics, I'm happy to send you the PDF report. Just send me an email and I'll send it back to you. So we look at estimated top line sales. This is annual revenue. The small center about 100,000, the next size 750, and the larger one 1.5 million. Out of that, we've estimated the owner's salary and benefits. Basically, the owner's take. Doesn't matter if you're taking a salary or draw, it's just the owner's benefit from it for working full time. Maybe 30,000, the smallest, maybe 50 for the mid, and then maybe 70 as for the larger. And then looking at profit after that. This is per industry metrics. At the smaller center, there probably isn't much profit after the owner's salary and all the other expenses are paid. The next size, yeah, there should be some extra cash there. And the larger size, yes, you get into more. I've looked at numbers for centers at the 150 and higher size, and this salary and profit for the owner, that's actually conservatively low. I've seen people pull more. This is doable. One reason I really want to show you gals this is that it is possible to make more money. The industry is just so under supported. This is really hard work. It's really important work. It takes a lot of skill, and you should be paid more. When I was a kid, I don't know, Luann might remember, nurses got paid nothing, remember?
Mm-hmm.
And now you can support a family on a nursing salary. What happened? People stopped going into nursing. There was a lack, and there was a lot of advocacy, and it changed. It's time for this to happen for childcare too. Given what is required to do this well, it should be paid more. So as we look at this owner's salary and benefits, as well as the profit, for smaller businesses to reflect the earnings of the business, we call it seller's discretionary earnings. We add those two together. Whatever the owner takes as salary and benefits plus the profit. So for the smaller business, it's the 30,000. For the mid, it's 110. For the larger one, it's 250. If you're reading about larger businesses, they talk about EBITDA as representing the earnings before interest, depreciation, amortization. The smaller businesses, you use seller's discretionary earnings and different set of multiples. Valuation multiple. For this real small one, maybe a 1 to get to the business value. That's about what you would value it at or price it at, about a 30,000. For the next one, you could get up to about a 2-3, and that would finance. You could probably sell it for about 250, and it should work with financing. The larger one, the multiple could go up to a 3 and give you about 750 in business value. Now this is another pitch to think about scaling up. So the smaller center compared to the larger center I'm showing here. The larger center, the revenue, the top line income from the families is 15 times what the smaller one is in these examples. However, the selling value is 25 times higher. That's because the valuation multiplier goes up as the earnings go up. So it's not a linear increase in business value. It starts to get more exponential. This is why you should think about going a little bit bigger with your center. Can you combine forces? Save on back office administration, because you'll start actually making money and your center will have much more value at the end. And by the way, I'm only talking about business value here. If there happens to be real estate as well included, you add that value to the business value for the sale. Okay, I guess we can go to the next slide here. So in this last slide, I've taken the 3 examples from the other slide of the 3 scales here. We got to have our business purchase price is 30,000, 250, 750. Looking at a structure, this is where the rubber meets the road. The deal has to finance unless you're getting a cash buyer, and you might get a cash buyer for the real little ones, or they might take a home equity loan to buy a real little center, but otherwise they're probably financing. If you're working with a more conventional bank, a lot of them want to see 25% down payment now. I think Heather's going to show that BCLF can help you out on that one, but a lot of the banks 25% in, which means you finance the rest. Loan terms, the length of the loan on business purchases tend to be much shorter than real estate. A conventional business loan is about 5 years. If you get SBA loan guarantee, you can go out to 10. If you're with an alternative lender like BCLF, they could extend it beyond that. It's helpful to have a longer loan term because that lowers your monthly payment. This one, I assume that this got an SBA program, so went out to 10 years. Here's the annual debt service for each of those 3 scenarios. So what do we do now? We calculate the sanity test. Take the seller's discretionary earnings from the prior slide, that's the owner's take, subtract the annual debt service that we calculated above. What's left? Remaining cash flow. That's what's available to pay the owner's salary and benefits to work full time and to cover. There has to be some buffer around the debt service, which the banks insist on for good reason. Things happen. So if you look at the smaller center, that's really tight. I mean, it's not even quite buying a job. You're going into some debt you could probably earn more working for someone else. But you get up to the next size and it's like, okay, that's not bad by Vermont standards. And you get up to the larger centers, like, okay, you're doing quite decent here. It really makes sense to buy a business at that scale because of what you could pay yourself or choose to pay your staff more, as Luann was pointing out. There's just so much more to work with when you scale up. That's why when we look around Vermont, tiny companies don't offer health insurance. It's the bigger ones that do. Simply with scale, you have more resources. So on that, I'd like to move on to Heather's slide. She's going to talk to us about the financing aspects.
Thanks, Lynn. Yeah, so moving on to the financing aspect, I'm going to just walk through some of the things that a lender, a loan officer, or an underwriter would be looking at if they were taking part in the sale of a childcare center. So the size of the center, as Lynn was just talking about, the larger the center, probably the more profitable you will be. Statistically, we've looked at the data here within VCLF, and childcare centers with 60 or more children are less financially stressed, and they can really meet those monthly debt payments and be able to pay back a loan. VCLF has found that the centers with more children do have sufficient income to make the monthly payments on large loans. And when I'm talking about large loans, I'm usually, $100,000 or greater. So if somebody was buying a center, including real estate and whatnot, and had 60 or more children, there's a greater chance of success there as far as making those monthly payments. Lending to the smaller childcare centers is more attractive when there are multiple streams of revenue, and we'll talk about that on the next slide. We can go to that one, Matt. So the information typically needed by lenders from sellers in order to consider financing a buyer. So both Luann and Lynn hit on this. We need the last 2 years of your financial information, typically your profit and loss and balance sheet statements, as well as your tax returns. That's why it's so critical to keep up on your financial, logging your financial information on a regular basis. If you're using a bookkeeper, an accountant, or doing the financials yourself and using something like QuickBooks, it's relatively easy to print those periodic reports and provide them to your lender. It's important for the seller and the buyer to be able to talk about the current financial situation and then provide that information to the lender. When there's a transaction happening and the buyer and the lender can really have that open communication about the financial situation and taking on debt, it really goes a long way with your lender and your bank or whatever agency that you're going through. We know not everything transfers with the sale of a center, but providing that financial information really provides the framework with the creation, helps with the creation of the buyer's business plan and projections. And when I talk about projections, I'm talking about the creation of a financial statement of what it's going to look like for the next 2 to 3 years for this incoming business owner. And any lender is going to want to see those projections. I would say, just as a side note, because VCLF is a mission-based lender, we can, for some of the really small centers, if there's a sale transaction, we can take a look at financial spreadsheets as opposed to using something like QuickBooks, although as Luann and Lynn said, it's really important to kind of get up to speed with that financial software. And then the breakout of revenue sources. You got your tuition from private pay, tuition from state subsidy, Act 166 tuition revenue, and the list goes on. Lenders are really going to take a look at those multiple income streams and see them as a strength. There's potentially some lower risk to large fluctuations in income if there's more than one source of income. And then we have a business resource center here within VCLF. And if you need to kind of talk through these different revenue streams and how that is a part of the income information that you need to provide to a lender, our business resource center advisor and manager is Elena Gustavson, and she is really excellent to be able to kind of walk through these details with you. All right, next slide. If the information typically needed by lenders from the sellers, again, we're moving on to real estate. If the real estate is owned, a lender will want the appraised value of the building. So an appraisal will provide their experienced assessment of the market value of real estate. This amount is important to lenders to understand the value of collateral available from the buyer of the business. And then if the real estate is leased, if you have a lease or you're renting, the lender is going to want to know, does the lease transfer to the buyer with the same terms? Will the buyer be finishing out the terms of an existing lease? And is the landlord supportive of the facility's use as a childcare center? And I say that because we do have some landlords that are incredibly supportive of the childcare centers, and it does go a long way with a lender to know that, you know, there's some solid support there.
And Heather, conversely, we've had landlords who had a relationship with the renter and really weren't open to childcare in the future. You know, that piece, it is so important just in terms of making sure the landlord is on board for childcare in general.
Yeah, absolutely, Luann. It really does help when you know that the space that you're leasing from a property owner is going to be there for you for the length of the loan term. And I know that Lynn talked a little bit about that as well, but it's tremendously helpful in determining kind of the security there. All right. Next slide, I think, Matt. Okay, so let's move on to the information needed by lenders from buyers in order to consider financing a buyer. So as a missions-based lender, you know, it's important for us to gather a personal financial statement and a credit history. And the reason that we do that is we want to make sure that if you're going to take on debt to become a business owner of a childcare, that your whole financial picture is going to be stable, that the debt that you take on is not going to become a stressor for you, for the business, or for your personal, you know, financial stability. We just want to make sure that all the numbers look good, your credit history looks good, so that the lender is taking a little bit less risk there. And then we're also going to ask for your business plan and financial projections, which I had mentioned a little bit earlier, usually going out 2 years. I think that given that the sale of a childcare business is not just a change in ownership, it's really important for the buyer to kind of plan or project into the future what the business is going to look like over the next 2 years, and be able to provide that financial assumption to your lender. And again, I can't stress enough, the good communication between the seller and the buyer is going to help tremendously in creating those projections. It's incredibly hard to put together a business plan and put together 2 years of projections if you don't really know the current state of the childcare's financials. So it's really helpful to have that good communication. All right, next slide, Matt. Multiple lenders may partner on an acquisition loan, and this is often a very good thing. VCLF will partner with banks, with credit unions, and some of the municipal revolving loan funds with our Vermont towns and cities, and it kind of spreads that risk, that financial risk, across the lending organizations, and it also allows for some of those collateral requirements to be a little bit more flexible. I think Lynn had mentioned some of the federal SBA loan guarantee programs, which can help with risk in taking on debt. Those are certainly an option. I don't necessarily want to go into a lot of detail on those loans. I certainly can have a conversation with anybody one-on-one about that. But I think what's most important to understand is taking on a larger loan and choosing to go with a federal program, a federal SBA program, that comes with federal bureaucracy and more stringent requirements with those federal programs. So we just want to make sure that it's an applicable option for the situation. And then I think the last slide for me, Matt. So in talking about specifically VCLF loan terms for childcare acquisitions, VCLF will provide a maximum of a 20-year amortization on childcare loans, and a 10% down payment is recommended, which is a smaller down payment than what you would typically see from a traditional bank. VCLF will amortize across those 20 years, but have a 5-year term. And what that means is essentially that longer amortization of the loan provides a lower monthly payment, so it's a little bit more manageable. But your loan officer is going to review that loan at the end of that 5-year term and determine if another 5-year term makes sense. Technical assistance is always available from our Business Resource Center for our borrowers. It may be a requirement for a loan to a new buyer if it's determined that some financial support is necessary for an individual buying a childcare center. And then every lender across the board is going to ask if you're borrowing money that you provide annual financial reports and a copy of your business taxes each year for the records. Your loan officer will review what you provide, just make sure everything looks good. And if things are not looking great as far as cash flow, VCLF has a number of different ways to provide support and help out and kind of make things look a little bit better. I think that's it for me. Happy to answer any questions that folks may have on the lending and underwriting aspect of a sale. And of course, I'm available for phone calls and email as well.
A question that came up, and I'm not sure exactly who it's for, and if it's something that will be answered further on, we can hold it. But one of the issues in Vermont around larger centers, larger childcare businesses, is there's a lot of rules around utilities and waste and water treatment. That Heather is very familiar with it, working at BCLF, and it is something that costs a lot of money to address and has come up recently in terms of folks interested in either opening or expanding their programs. And so I know I can just quickly say that we have had conversations with folks in state agencies around what we can do to work with the state around the requirement. And then also, I think for this group, the question is around, is there funding for folks to address this issue if in fact they find a business or they're selling a business or buying a business and this is an issue?
Luann, that sounds like an excellent topic to advocate for. If that's a constraint on people's centers, is there a way to remove it or to fund the additional water or sewer work they're going to need in order to be licensed?
Yeah. And that is happening.
Yeah.
But yeah, it's an issue.
Yeah, and I would say from a lending perspective, ideally it's for a childcare center, it's not something that a lender would necessarily want to do. If it's a small project, it's a small sewer issue, if that even exists, perhaps. and the reason behind that is that additional debt on, you know, in childcare where the margins are so slim, just adds so much more stress. So if there are other ways to take care of the problem, to do a renovation, to fix plumbing because somebody flushed something down a toilet that, you know, these things happen in childcare, then that's preferable, and VCLF is happy to work with folks on that, you know, happy to work with our borrowers on that. But it just seems like borrowing for something like that really can add a lot of financial stress, and there are other ways to mitigate it.
Yeah.
Luann, are you looking at the capacity requirements? I mean, are the water and sewer requirements really consistent with actual use? Because pushing back there, if it makes sense, if it's supported by data, might be a way to ease the burden on some centers.
Yeah, it's a real issue, and there are people working on it from an advocacy perspective, but it came up, and I know it's on the minds of some folks who are, you know, thinking about this from, you know, we're recommending increasing your size, and we also know there's some constraints around it in Vermont. The other thing is, I would say, you know, try to find places with public utilities. Unfortunately, in Vermont, we have a lot of small towns that don't even have public utilities.
Yeah.
And so that's a real issue. So it's something that is being worked on. I know it's an issue. It's not particularly the focus of this particular afternoon, but something to think about.
Right. Okay, now we're moving on to the actual transition pathways, the exit options for moving on from a business. So on the next slide, here are the 4 main pathways. A third-party sale, which means a sale to someone outside the business, either to an individual or a strategic acquirer, that's someone in your industry or allied to it, or a financial acquirer, that's an investor. Another one is sale or gift to family members if you have a next generation wanting to come in. The third option is a management buyout, which really pertains to larger businesses with a second level of management. For smaller businesses, it's really a sale to key employees, maybe 1, 2, or 3 of your top people, or a sale to all employees by a worker cooperative, which Matt will talk about a bit more. There's also a sale structure called an ESOP to all employees, but those really work for much larger companies than the ones on today. So not all pathways are viable for all businesses. That's part of your exit planning, is to figure out which ones first might work for you, might be viable, and second, which ones are interesting to you. For example, a very small business generally is of no interest to a financial buyer, like a private equity group. I mean, they're looking to scale up and make a lot of money, so they're not going to buy something small. But a small business, individual buyers, that's where they play, you know? And there are many smaller daycare centers who, if the geography is right, may be appealing as an acquisition to a bit larger center in the region. That's just something to think about. That's a strategic acquisition. It's good to keep more than one pathway in mind. If one doesn't work out, you can switch to the other. This is when you're actually looking to implement. I know owners who've been really excited about selling to employees, and then the employees were not interested. So at that point, the owner turns and says, okay, I'll do a third-party sale to someone outside. Vice versa, owners have tried to do a third-party sale, but for one reason or the other, hasn't really been a fit, and then they'll turn back and figure out a way to work with one or more employees to get the transition to happen. So we'll talk about all kinds of these sales, but I noticed on the registrations there was a question about what if I don't have a buy-sell agreement? And let me talk about that briefly. That's kind of a variation here. A buy-sell agreement is when there is more than one owner of a business. So your partners, either set up as a partnership or you each have holdings under a corporation, S Corp or C Corp. So a buy-sell agreement is an agreement the partners set up often before they're exiting, that lays out what will happen if one of them wants to move on and the others don't. So are they allowed to sell their shares to someone outside? There are a lot of ways these can be structured, but often the partners who are staying in the business will get a first right of refusal to buy out the one who's departing. The other piece is that the partners normally agree with the help of their accountant on the formula that will be used to value the portion of the business that's being sold back to them. And the third thing that's normally done is people often get, they used to call it key man, now it's key person insurance, life insurance, so that if one partner would die, the remaining partners can buy out their share. Otherwise, generally the spouse or the family of the partner who died would inherit there, and you'd have to be operating with someone who wasn't in the business before. So that's what a buy-sell agreement is. If you're in partnership with someone, it's really nice to have one. Some people set them up when they set up the business, others along the way. If you're in partnership and don't have one, and you're really ready for one of you to exit, you can do this without the buy-sell agreement. You just need to strike the terms of the purchase and go to an attorney and have them draw it up. Okay, figure out what you're going to do for that specific case, if you're going to buy out someone who's leaving, and just make it happen. So I hope that covers the buy-sell. So let's move on to the various transition pathways. Of the four, there's some commonality. For all of them, the process can be lengthy. It's good to budget at least a year from start to finish once you pull the trigger and start the process. It just takes a while to gather information, review it, to talk to, if you're particularly going externally, to market the business, to work with various buyers, to have them get preliminary financing approval. It's not fast. There are also no guarantees that any particular transaction will occur, or even that a business will successfully transition ownership. So particularly with really small businesses, if you have a good buyer in front of you, somebody that you think can really do well with this business, is likely to get financed, I always recommend that people treat them well, take them seriously and treat them well. It doesn't mean there's another 40 buyers out there just like that. It's Vermont, it's a smaller market. If you have a good fit, take care of that. And it may take a little longer than you thought to get it to the finish line, but just stay with it. And then selling a business is emotionally stressful, a major life transition, and it's a lot of work. When I'm working with owners, I help them all I can, but the best advice I can give them is whatever they normally do to take care of themselves, they need to do more when they're going through the process, and just acknowledge how big a transition they are going through. Okay, let's move to the next. Okay, common issues. It's not just the price, it's also the terms of the transaction. So some terms might include earnouts. An earnout is where you don't get the entire selling price at the closing table. Getting the remaining value is dependent on something occurring by a certain date. For example, in childcare, an earnout might be, 12 months after the closing, have you retained X number of families and slots, or X amount of revenue? Because if the revenue has all fallen away, they're not going to be able to pay the full price. Not saying an earnout has to be there, but if you're on the seller side, sellers want to get all the money they can at the closing table. The buyers want to pay as little as they can at closing. That's the dance. An escrow is where some of the selling price is held back, maybe up to a year. That's to cover any contingencies that perhaps were not disclosed. If the center were in a legal dispute or an environmental issue or hadn't paid some taxes, that money would be used to cover that liability that was really the seller's. Seller financing is very common right now. Actually, ever since the end of the Great Recession, many of the conventional banks expect the seller to hold part of the amount as a loan. Sometimes it's secondary, usually it's secondary behind the bank. So you may need to finance part of the deal. Tax advantaging strategies. That's something that can be negotiated. If you're set up as a corporation, whether you sell as a stock sale or an asset sale, that impacts the taxes you pay as a seller. If you're not set up as a corporation, it's an asset sale, but how you allocate the sale for purposes of taxes impacts how much you pay. All these are negotiable. These are things where you need a good advisor to help you. One other term is sometimes sellers want to retain equity in the business, some ownership, particularly if the business is growing a lot. That can be an option for you. Okay. And it's a great win. When you get this to happen, it's a great win. You know, everybody's usually pretty happy after a successful sale. The seller's happy to move on, see the business taken care of, their customers, their staff. The buyer's excited to be in there, and the community's happy here. You know, the center's carrying on. Okay. So third-party sales, as we move on to the specific approaches, often bring the highest selling price, and they may offer some opportunities for tax advantaging of the sale proceeds. I've talked about the asset sale versus stock sale and allocation of asset sales. And they're very common. They'll include terms such as earnout or seller financing that may bind you for a couple of years, maybe shorter, but for a while post-closing. Another term that's common, they may want you to stay on for a while as an advisor, either in a consulting role for pay or just as part of the deal they're paying to stay on for a number of weeks to advise. Okay. You could sell or gift the business to family. If you're interested in keeping it in the family, you could also choose to be the banker, which allows you an income stream. One caution, if you do sell to family, it's not an arm's length transaction. It's really important you get a professional business valuation done by an accountant. This is looked at closely by the IRS, so you really are going to have to pay for a full-blown valuation there. And then when you are giving or selling to family, if you're selling, it's like, okay, how much do you need? Have you really deserved for your work? What's the business value versus how much debt do you want to saddle the next generation with? It's just a balance there. And if you want to gift part of it, there are mechanisms where you can do some wealth transfer under estate planning, and you may be able to bypass some taxes. Just something to keep in mind. A good attorney can advise on that. Okay. When you sell to your key employees, you may not receive the highest price because generally employees are making a lot less than the owners. And employees typically lack the cash down. This is not unique to childcare. This is through many industries. They generally don't have the non-borrowed funds for initial bank financing. And this is where planning can come in, because you can work around it by having them start to buy in over several years. They'll buy in a piece at a piece, and then they have enough equity where it's possible for a bank to finance them. You may also sell or finance them for a while till they get enough equity, and then they can go with a bank. And you may also, on top, among that, use some SBA programs for loan guarantees. It generally can take a little creativity to sell to employees, but for smaller companies, these can be your best buyers. Smaller services companies, whether they're engineering firms, accounting firms, all the time. This is how they transition. The younger people coming in buy out the more senior people. What does that mean? It means you're thinking about who you're hiring longer term. You're hiring your successor, which means might they develop the skill set and might they have the interest? And this can be a conversation that you're actually having with these people as you're hiring in. Okay. Yeah, when you're selling to employees, particularly with smaller businesses, this can be a great way to keep a good person on. If they know they're going to be working into ownership. And like I mentioned before, this may influence your hiring choices as you plan. And then the last pathway is a sale to all employees, which Matt is going to talk to us about.
Thank you, Lynn. Yes, so the Vermont Employee Ownership Center where I work, our work is around broad-based employee ownership, which we define as arrangements where at least all full-time equivalent employees have a path to becoming co-owners of the business. And Lynn mentioned briefly the employee stock ownership plan requires certain scale, minimum scale, and it's much an order of magnitude more costly to set up. So while some of the folks on the larger end might be worth at least looking into it a little bit, we're going to focus primarily on the worker cooperative model, which is more of a direct form of ownership by the employees, whereas the ESOP is essentially the company is owned by a retirement plan. So a co-op, in the most general terms, is defined by the kind of international trade association of co-ops, is a business owned and democratically controlled by its members for their common good. And there's different kinds of them. You have things like credit unions and food co-ops, where the members are the customers. You have things like Cabot Creamery, where the members are farmers who market their product through the co-op. But in a worker cooperative, the membership is folks who work in the business. There's about 500 nationally, about 16 in Vermont at last count. And the core idea is that each member of the co-op buys one share and is a direct owner of the business. Those members elect a board of directors that governs the co-op and supervises the manager, and also they share in profit on the basis of labor contribution, which is usually hours worked or W-2 income. So they tend to receive market rate wages, and if there's any profit at the end of the year, it's divided up amongst the members on that, according to whatever formula is decided upon. Employees aren't owners when they start at the co-op. They usually have to work for a trial period. We usually see anywhere between 1 and 5 years to make sure that they're a good fit, and it's a long-term thing, and then they're invited to buy in as members. Management can be conventional or flat, and so that means most co-ops we see tend to have you have a manager, you might have assistant managers, or a general manager who supervises the employees and has hire and fire power over them. Especially for some smaller ones, there can be approaches to management that don't have that traditional management role, but most do. It's one of the reasons why we see that for the smaller size versus the ESOP is that it can really work for small companies. So minimum of 3 employees usually. I think 5 to 30 is kind of the range we tend to see in Vermont, although there's some larger ones. So the employees do directly buy in. But one key nuance, and this is one thing that can make it kind of more affordable for employees, but also make the financing a little more tricky, is the share price is not tied to the valuation of the business, but rather you kind of arrive at a price that is high enough to feel like real skin in the game to everyone, but low enough that the lower end of the wage scale can afford it, sometimes through payroll deduction. And that share, each employee owner owns 1 share, and they get a vote for the board, and also a share of the profit as the rights that are attached to that share. So the employee owners or the employees, then, if you're going this route, have to be involved in the sale process. And that usually looks like a steering committee of employees comes together and does the work of kind of investigating and representing their interests as the buyer in the transaction. And the transaction usually is 100% of the business is sold, although there are ways of doing it so that a majority is sold and a minority of equity is held by the seller until a later date at which the members buy the rest of the company. So when thinking about a transition to this structure, we usually think of kind of 5 steps. The first is exploring, learning about how it works, and then seeing, as Lynn mentioned, are the employees really interested and motivated? Is this something that they can see a good future for themselves in? If yes, then it's looking at feasibility, check can it support the debt if debt's needed? What are the operational needs? Sometimes an owner will stay on be on both the buy and the sell side and stay on as an employee owner for a period of time, which can be great for management continuity and bringing up the next layer of managers. But if this is your way of retiring, you're going to want to have that clear sense of how the operations will work when you're gone. And then going to the prepare stage, it's designing the bylaws, setting up, talking to capital providers who might be either lending or investing in financing the deal, developing that management plan, electing the co-op, the members of the founded co-op, electing their board of directors. Then you get the lawyers fully involved to do the transaction. And then afterwards, the role of employee owner is, it has an added layer to the role of simply an employee. So there's definitely kind of work both in terms of developing how do you onboard new people and communicate what it means to be on track to be an owner, and engaging in support networks with other co-ops and similar businesses to sort of share some knowledge and practices and things like that. So there's kind of an ongoing education piece of the puzzle. And so similarly to the question of selling to a key employee, selling to all employees has some of the same financing challenges where you're oftentimes selling to a group that doesn't have a lot of personal liquid wealth that they can bring to the table. So usually we see the member shares, that kind of member contribution being somewhere in the range of 2 to 10% of the total financing in a deal, although it can vary. Usually if there's an outside lender, they oftentimes will want to see a seller's note for some portion of the sale, kind of showing that the seller has confidence and skin in the game. There are some specialized lenders, and this is important because unlike sort of say a sale to manager, oftentimes personal guarantees can get unwieldy, because if you have 10 owners, or some of whom have significant property and others of whom have very little wealth, there's some equity challenges around how do you different people bearing different amounts of risk. So some of these specialized lenders who know the co-op sector well are willing to lend without personal guarantees or accept other kind of forms of more limited guarantees or collateral. There are some social investors that are interested specifically in this structure. One example locally is the Vermont State Employees Credit Union, which has a co-op capital program will put out up to $150,000 in preferred equity into co-op deals. And there's others who see this as, for mission-related reasons, something they want to invest in on patient kind of friendly terms. And then there's kind of friends and family or community raises to sort of support this. There's some great case studies of this, but you can go to, simply on a small scale, going out to the co-op members, going out to the folks they know to bring in some patient-friendly investment, or in certain cases going out to a broader community. And in the case of a childcare center, even thinking about are there folks in the community of parents who'd be willing to sort of invest in the future of the center or other things like that. So I'll just spend a moment talking about one example, which is the New School of Montpelier, which is a private school that provides services to school districts for children who are very kind of high needs, oftentimes like 2-on-1 type staffing. So they were the founder of the school decided that she wanted to exit. Felt after exploring the options of a sale to an agency or other things like that, decided that really it made sense to keep it independent and that this was a path that she wanted to try to go down. So the group of employees, there's a kind of core of them who formed a steering committee that did the work of developing the bylaws and learning about how it worked and talking to lenders. And after in their cases, they kind of had a seasonal workflow where there were times they had a lot of time and times they had a little bit of time. The whole process took them about 2 years to get to the point where they were ready to transact. And when the financing came around, and they had a lot of folks who were making fairly low wages, so they set their share price pretty low. It was $100 down and another $400 that would be paid out of payroll deduction over the course of a year. And then a number of members made individual loans to the co-op to supplement that. And then the Cooperative Fund of New England and VITA provided some additional lending, and the seller held a note, and so they converted in 2015 and have been operating under this model for 5 years now. And I know there's a number of also examples in the sort of early childhood care sector in other states that have used this model as well. So I'll just finish this portion by saying we'll be doing a session next week that kind of goes more in depth on this approach to ownership succession and how it works. So we'd certainly welcome folks to continue that conversation there. And with that, I will move on to any questions, and I'll invite folks to throw those in. And looks like we have.
So we did have a question about whether this would be available if it had been recorded. And so I responded it would. And we have kept all of the trainings that we do at Let's Grow Kids available on our website Let's Grow Kids website. I don't know, Matt, if you will also have it available somewhere else, but it will be on the Let's Grow Kids website.
Yeah, so I'm recording it, and I'll put the recording. The EOC has a YouTube channel, so I'll just kind of throw it up there, and then I'll send Luann the link, and she can send it out to all the folks who've attended.
I'm excited about next week's training as well, because it'll be interesting to hear specifically about these folks who've worked with childcare programs, and then the opportunity, participants will have the opportunity to have some one-on-one time with the presenter, which I think will be really helpful and effective.
So the last few slides we have here are just sort of some contact info. So if folks want to reach out and get in touch with Lynn about I know she offered some resources if you wanted to email her. So her contact info is here.
There is a question about help for offering benefits. That is one of the big issues around running a childcare business. And I know from experience that it is an expensive line item in the budget. And it is something that some programs have found that they have been able to do. And there's also some work happening with, again, advocating around support, around access through state systems around benefits for childcare employees. So more to come on that. Unfortunately, this one session can't address everything. So we will keep working on the advocacy issues that are necessary for our field, and keep you posted through all of our Let's Grow Kids venues.
Yeah, so. All right, so invite any other final questions folks have, and certainly, you saw the contact info, and you'll get this as a follow-up, but any final thoughts also from presenters that either Heather or Lynn you'd like to share?
I would say from a lending perspective, any questions anybody has regarding underwriting or taking on debt during this process, just feel free to reach out to me at any time, and I can help answer questions. And if I don't have answers, we have so many resources available to folks to get them to the right person.
And I guess I'd like to add that some of the challenges that have been mentioned for childcare centers, they're not unique to any individual center. They're shared by so many, and all that you gals can do to band together and we're hearing a lot about systemic changes. It's what's needed here to make this industry sustainable and really help your lives out. I really wish you all the best. I'm a resource here as well. And I'd offer those industry metrics if you'd like them. Just send me an email and I'll send you a copy. Thanks.
All right, so I'll stop the recording now as we are at just about at 2:30. Luann, any final things for the attendees or final reminders?
I think we're set. I'm looking forward to next week. This was a great panel. So I took great notes, even though I've heard you talk before. I took a lot of notes, and I think this has been helpful, and we look forward to more work around this. And yes, reach out also to me, Luann at letsgrowkids.org, for questions that might be something that I could help you with. Thanks so much. I appreciate you folks.